With leap options, we are buying security and safety. When you do shorter term options, you don't need anything that goes opposite of what you expected can cost you money. Today I'm down 30. The market took away 31,000. But all of my plays right now, except for one, doesn't expire to 2023. Feel me? So I now have the opportunity to see those plays turn around. Everybody with me? All right, cool. Let's get into it. We talked about 6 to 12 trades a year. All right, this is an important tool for me. I'm getting you through tools right now so you can understand what we're using. So once we get into execution, it's simple. All right, first tool is barchart.com. How many people ever heard of barchart.com before? Let me see it in the comments. You heard of barchart.com before? No. Yes. I use it for long term when I'm doing breakdown and studying businesses. Yes. Devin Waits said, then we'll do it barchart.com. When we on here, let's say we're going to use this. We'll put a ticket. This is free, y'all. This is free. This is a free tool you can use, right? So barchart.com. We'll put our ticker symbol in right here. Boom. Here's the thing. Listen to me well right here. All right? Listen to me well. Whether it's an ETF or whether it's a single stock, we always want to look at the performance of that equity. Did I make myself clear? Whether it's an ETF or whether it's an individual stock, we always want to look at the performance of that equity. Do we understand that? Because performance is going to tell us how that ETF or how that individual stock has performed over the last year. Right? Over the last year. Keep that in mind. Look at this because we're going to run it back. You're going to see why you're going to need this. Another thing we like to look at right here. I want you to look at this right here. This first section right here where it says key turning points. I want you to look at this and pay attention to this. I'm about to tell you some game. I want you to don't even worry about nothing. Look at me. Certain parts I just want you to look at it and be like, damn, I got it. Right? You with me? I see my man got the red Wall Street chapel hood special. I like that. I see you, King. I see you, King. I see you. All right, so check it out. So what I want you to write this in your head. I always want, and don't trip, I will tell you how to get strike price. So I know y'all, chat, where the strike price at? I'm going to tell you how to get strike price. Don't trip. I always want my strike price to be above this third point of resistance. Did y'all take that in? I always want my strike price to be above out the money. When I'm dealing with out the money, let me make sure I say that. When I'm dealing with out the money, I always want my strike price to be above this third resistance point. Make myself clear? Now let me explain it to you why. All right, so if we're looking at this price right here of the underlying asset, let's say this is the price. This is the price of the stock, right? This is the price of it. This is the last price it was. So resistance says when the stocks hit, think about this. Resistance equals the roof. Support equals the floor. Do we understand that? Resistance equals the roof. Support equals the floor. right? Resistance equals the roof. Support equals the floor. Check this out. The market consists of two things. Does anybody know what that is? Before I said, the market consists of two things. Does anybody know what that is? Bingo, y'all got it. See, y'all smarter than y'all think y'all are. Buyers and sellers. So check this out. Buyers drive prices up. Sellers drive prices down. Here's the thing. If a stock breaks the first level of resistance, this is why I love this bar chart. If the stock breaks the first level of resistance, it now hits the second level of resistance. But here's the thing. What resistance means is it can hit it and it'll come back down. Right? It'll come back down to support, one of these support levels. It is a good chance that a stock can play within this area because it's going to keep going through support and resistance. Right? Y'all with me on that right quick? This is important. This is important. This is important. The thing about support and resistance is, in a bad market, if the stock breaks through this third level of support, that means we're in trouble. It is now creating new support levels. That means sellers are selling, right? It is creating new support levels. On the flip side, if it breaks this third resistance level, it now means it can run. Everybody with me on that? Everybody with me on that? So let me get a question right quick. Why would I want my strike price to be above, if I'm out the money, this third resistance point? Why would I always want my strike price to be above the third resistance point? So when I set a strike price above this third resistance point, it's because I know now, once it breaks this 153, it is now in run mode. Trap, how you come up with that? All right, cool. So anytime there's support resistance, so last year, and I'll get into the Apples, though, I'm gonna show you the play we did last year so you can walk through it, and then tomorrow we'll get into the next thing. So before we did the Apple play last class, I said, listen, I was like, yo, if Apple ever breaks, once it breaks 138, I said, once it breaks 138, we'll see it into the 150s easy. It stayed between 138 and 132. It broke 138, we got to 157. It's with any stock. Once you figure what a resistance is, and that's really what charts are for. Charts tell traders where support and resistance is. That's what they find. Charts are setting trends for them. Yo, this is a trend. That's what they're looking for. I'm not a heavy technical analysis person. So once bar chart did this for me, it took me out of charts because I could come right here and say, okay, here's my resistance points. Once I do my calculations, which I'll show you all, we want to always make sure our strike price when we're out the money is above the third resistance point. Did I make myself clear? We trap and say we trap. All right, cool. Cool. All right. So I want to show you something right quick, just so you can walk through this right quick. This is bar chart. We're putting in these stock, using it here, right? Just look at it, you'll see it. We scrolling, we scrolling, we scrolling, we scrolling, we scrolling. We seeing everything here. We're now going down to where I showed you the 50. where we're looking at the performance. Right? Y'all see that? Everybody see it? All right, we scrolling, just so you can see it. Can you see 1, 2, 3 support levels, 1 through 3 resistance levels? So now you're looking at bar chart live. Did everybody see that just now? Or do you need me to play it again so you can really look at it? I'll play it one more time. So you're going to go here at the top. Microsoft was what we use here just to show you. You'll go right here where it says performance overview. Performance overview. Scroll down. You'll see it. I'm just letting you see the whole bar chart setup so I know I showed it to you. Right here, we see it 52 week. We're looking at it. Price, and sometimes it'll go 52 week, 1 year, 3 year. All right, cool. We're looking at the 52 week. We're scrolling down. I want you to see the whole play. Now we're looking at support and resistance levels. Looking at support level 1, 2, 3, resistance level 1, 2, and 3. Did everybody get that? I'm taking you on a journey right now so you can see this. Right? Did everybody see that? Good. All right. We're walking into this, y'all. We're walking into this. Okay, so let's look at some. So now we're going to look at the times when we get options contracts on sale. Now we're getting into the sweet science of this thing. Right? We're getting into the sweet science of this thing. I love it. Right, quick before we move forward. How everybody feeling right now? Dev, how you feeling right now? How you feeling? You good? Good. How everybody feeling right now? Talk to me. We walking y'all through this. Yep. Good. Not a problem. Love it. All right. So my thing with options is this. And I'm going to just keep it 100. I'm not boasting. I'm not bragging. I have never, ever heard of an options trader getting options at a discounted price. Never. Until me. I've never heard it. And the reason why it came to me was because I realized that this can happen. I realized that most traders fail because they are more so looking at the technical analysis and forgetting the fundamental analysis. And the fundamentals is what truly makes money in the market. Why do I say that? Because a fundamentally great business will perform good over time. If you think about a casino, the casino's idea is to get you to chase. That's how the casino win. If they can get you to chase money, they can get you there. Am I right or wrong? Right? Instagram has made the market seem like a big casino. For me, I understood that this is a wealth building machine that prints money. And if I understood that the machine prints money, then I never had to be in a rush. Even with trading, and everybody asking me, yes, I am plugged in. We good to go. I ain't gonna turn off tonight. The one thing that people fail to realize is that this machine will print money for you over the long term. What makes you a great trader is consistency. If you can have patience and consistency in this game, you will succeed more than you fail. Okay? I want to get one elephant out of the room right quick. You will 100% make a losing trade. Damn it. God damn, man. Listen, you will 100% make a losing trade. Here's the caveat to that. It's okay. You know why? Because the goal is to have more winners than losers. As a trader, I want you to write this down. A losing trade is considered operational expenses. Write that down. A losing trade is considered an operational expense. An operational expense. That's the cost of playing the game. Everybody got that? A losing trade is what we call an operational expense. No matter how great of a trader you are in time, the market will do something that will cause you to lose a little money. Don't take it too hard. Last year when I did this in October, I was up on 9 out of 12 trades. I cashed out on 2 of those because one of them was a December call, cashed out on it last month. One of them was a January call, cashed out on it late last month. So I'm now okay. I have a couple losing trades right now, but it's okay. Right? So I don't want you to get discouraged about it. What I will tell you is this: emotion is the enemy of success in this game. Emotion is the enemy of success. What I want you to do is, and the reason why y'all gonna have this during that Christmas holiday is because I want you to do this. I want you to take time to study this, learn it, put it together. Once you get a blueprint, stick to it. Stick to it. Another thing, there is a such thing as over trading. Right? So let's say you put $10,000 in your account, $5,000 in your account. There's no need for you to spend the whole $5,000 on your first trade. So you put $2,000 in it. There's no need for you to spend everything on your first trade. The goal of this game is to scale your account, trade by trade. Now, I'm going to say something. I'm not a money person. I don't talk about money a lot. I talk about execution. I started my account with $300,000. I'm at 7 figures right now. My options, my Trap Masters member know it. I done showed it to them before. I showed it in my last class. I'm at 7 figures now. The goal for me was to get to 7 figures. The goal for me is to turn that 7 into 8. I'm gonna keep it real. Because the machine prints money. If you take your time and understand what I will teach you over the next 2 days, you will print money. I don't guarantee much, but I guarantee that. I don't guarantee much, but I guarantee that. If you take your time, if you don't rush, if you don't get distracted, if you take this serious, you will print money. I have people who got in the money trades, first time ever, they up 50%, 30%. I have people who did out the money trades, first time, they up 150, 200%. First time. I promise you not. I tell you no lie. Some of them in here tonight, in my mentorship, they took the same class. Machine will print money for you. Do the process. Okay, so I have those moments where I do that sometimes, y'all. Don't pay me no mind. All right, so here are the ways where we can get options at discounts, right? So first we want to understand macro news, things that happen that cause people to panic, right? That are causing people to panic. So COVID causes people to panic right now. It is a real thing. It will cause people to panic, right? Anytime the Federal Reserve starts talking about interest rates and money, cause people to panic, right? One thing people don't want is higher interest rates, right? Another thing is anytime you hear a report about job numbers going down, it's cause people to panic. Because if people aren't working, that means the economy can't run the way it's supposed to run, right? Another thing is quad winching. So let's think about that. Let's talk about that. Some people never heard of that. If you're an investor, you're supposed to know this day, right? The one thing about this day is these days happen every third Friday of March, June, September, and December, right? My trap masters who were in the first options class should now be looking for options on discount because quad winching happened on the 17th. So let's talk about what that is. So quad winching happens every March, June, September, and December. It's the third Friday of those months. What happens during that time is the big institutions, the pension funds, the hedge funds, banks, they are rebalancing portfolios, options contracts, single options contracts, futures contracts. Y'all heard of these things before, right? They are rebalancing them. They are expiring on those days. Hear what I'm about to tell you and hear what I'm about to tell you well. After that third Friday in those months, I always look at a 7 to 10 day window where I see the most volatility in the market. And if we paying attention to it right now, Friday was the winching day. Today is Monday. Both days, we saw the market down. Am I right or am I wrong? So we looking like, man, the market going crazy. I'm like, yo, it's winching, y'all. We good. We ain't tripping. We understand what's going on. Once you understand what's going on in the market, you don't panic. The people that panic is the people that don't understand. Right? Remember what I told you. Emotion is the killer of success. And when you don't know how the market is moving, it will cause you to move off emotion. All right. So what happens is we always want to get options contracts when the market is red. Now, check this out. Not every red day is a buying day. And I'm going to get in here and we're going to show y'all. Right? I just want you to understand this. Red day isn't a buying day. We're going to show you how to look at contracts and see when they're on sale. Here's what I want everybody to do. I want everybody to understand that. Damn, my head went blank right quick. I want everybody to understand. I want you to have 10 to 12 companies that you use that are fundamentally sound. 10 to 12 companies that you use that are fundamentally sound. I want you to have good balance sheets, good income statement. There you go. I see you, Deb. This is the key, because if you have your watch list, you don't have to go scrambling looking for companies. And I told you what to set. I'm going to show you how to write out your plan. Let me write this. Text this right quick. All right, let's go. I'm going to show you this Apple Play that we did. And I'm going to show you why we did it. The reason why, because I want you to look at this. And once we get in tomorrow, I will show you a new play that we can execute on. I will show you how to move a plate, and now it'll make sense. So right here, we're in E-Trade. This is what I use. I use E-Trade because E-Trade has this option. And I'll show you that later. E-Trade is what I use. So we are looking at this time, at the time of this call, Apple was 146. At the time of this trade in October, Apple was 146. Right? Check this out. You see it. 146 price. 146. Right? If we look here at 146, this was quadruple winching. September the 17th. It was quadruple winching. If we see here, we can see what this trade, these options contracts were $8.25. You see that? Look where it's at. See where this line at? I want you to look at something. Right here was before quadruple winching. This is 100% about a $12 trade cost right here at this high. Once winching hits, we see what happens from here to here in a day's time span. You see that? We're looking at it. This is the proof. This is where it's at now. You see that run up? I'm not smarter than y'all. Didn't do nothing different from y'all. All I did was wait till quadruple winching, which was the 17th, in this time frame. But what happened also was, remember I told y'all 7 to 10 days. Within that time frame, it went from here to here. We wound up getting in a trade at $6 a contract. Some of us got it for $5 a contract. Before quad winching, we are now looking at about $12, $13 contracts per contract. We let the market do what the market does. It went from $8, a couple of days passed, went down. We got it at about $5. Some of us got it at $5. It was at 146. I remember us getting it at 139. Every time I do an options masterclass, I'm going to always do it around the quadruple winching time, because that is when I make trades. I don't make trades outside of that. I only make trades during that time period, or if a massive event takes place. You feel me? Other than that, if the market is green, I have no reason to look at options. If the market is green, now I'm trying to buy an option right here. That ain't what I'm trying to do. This is one reason why most people fail. All right, let's go. How many of y'all, I got y'all attention? I feel like I got y'all attention right now. I feel like before y'all was looking, y'all like, all right, Trap, get to the shit, get to it. And now I feel like y'all like, oh, Trap on some shit, right? All right, it's cool. All right. I always say that the market must submit to fundamentally strong companies. Why? Because if we look at businesses that are really good, they perform well over time. And they don't take as much beating as a business that's not fundamentally sound, unless there's an event going on. All right. Remember, I told y'all about 3 Ps. You need to write an exit price. You need to write a strike price, a profit price, an exit price, and a retreat price. These are my Ps, yo. Strike price, and we're going to talk about that. Profit price and the exit price. Strike price, profit price. This is the price that you want to take profit at. So one of the things I will say is this. When we are looking at options contracts, we are looking at contracts. I want you to have a price where you take profit. Why? Because as a beginner, as somebody who's new, remember we're always talking about risk tolerance, right? We're always talking about risk tolerance. And one of the things about risk management is risk tolerance is knowing, okay, let me take some profit right here. Right? So you set those prices. It can be, once my options get, you cannot take profit with one contract. Let me say that. You cannot take profit with one contract. Does that make sense? So because you got one contract, you have the right to 100 shares. You can't sell 50 of those. They come in 100 share increments. Y'all with me on that? They come in 100 share increments. So you can't say, I want to sell 50 of these. No, you have to have 100 contracts and then you can sell 50 contracts. You have 2 contracts, you can sell 1 contract. If you have 10 contracts, you can sell 3, 4, 5, whatever. But if you have 1 contract, you cannot take profit. You got to sell the whole thing. Everybody with me right there? All right, cool. Now, one of the things I'm gonna do, we're gonna talk about deep in the money. This is an easy play for me to show y'all. It's not even hard, right? So when I'm looking at a deep in the money play, listen to me well right here. A deep in the money play is gonna go like this. This is simple. This is quick. This is easy. It's not even hard. My deep in the money play, we can do this. So if you get a stock right now, Dev, I'm gonna use you again, right quick. I'm gonna unmute you right quick, Dev. Dev, give me a stock that you like right now. That's strong, fundamentally strong, sound. Jamila, let Dev unmute himself. There you go. Go ahead. You still ain't? You still ain't?
Oh.
All right, there you go. Give me one company that you like that's strong.
Mine's is Apple. That's my strongest one.
Say less. Good company.
Strongest one.
All right. Current stock price, how much?
Shoot, hold on. I haven't even looked at it. Hold up.
Just somebody tell me Apple stock price right quick.
It is 171.18.
All right, 171.18. All right, cool. So here's a deep in the money play, right? Here's a deep in the money play right here. I'm not telling about it to do this right now, right? But I'm just showing you a deep in the money play is an easy play for me to do if I wanted to do deep in the money. So what I would do is I would take 171.18, right? That is the current stock price. So for me, 5% is so we looked at the Apple play. Now, mind you, this is the Apple play. The current price at this was $46.97. So if we went deep in the money, 5% is in the money. That price, that strike price would have been 139, right? 15% equals deep in the money, right? It was 124. 20% was 117. Now, let's break this up so you can understand what I just did. So deep in the money means you're buying a contract with intrinsic value or equity already into it. Do we understand that? All right, cool. So if Apple price right now is 171, check this out, and we minus 15%, which would take away $25, it would give us a $145 strike price. So we were already, now you see why it's called deep in the money, right? You understand it already? You see what I'm saying? You see what we just did? So let's look at the current one. This was the strike. This was the one we did last year. Don't look at the out the money. Look at the deep in the money. All right. So at the time, Apple strike price was $146.97, right? we picked out the 15%. That gave us deep in the money. 15 and 20% are deep in the money, right? Here's what you want. You want to go 15%. That gave us 124. And we wanted to have a delta, and I'll get into this tomorrow, of 0.80 or higher. Why? Because if the delta is at 0.80, that tells us if the stock move $1, the option will move 80 cents. If the delta is 90, if the stock moves $1, the option moves 90 cents. If the delta is 1, the delta tells you how much money the option moves with the stock price. So if you're going to buy deep in the money options, you want that delta to be 80 or better. The reason why you want the delta to be 80 or better is because you're paying more money for this equity already in this option. Did I make sense just now? Okay. If you out the money, you taking a risk. Don't worry about that. If you deep in the money, remember, you're paying more for the equity already built in, right? You're paying more for the equity already built in. So because you're paying more for the equity already built in, you want that delta to be at 0.80 or 1. So now every time the stock moves, your option is moving 80 to $1 as it moves. Does that make sense? You with me? So because you're paying more for it, you want to get the best bang for your buck. Everybody with me? Everybody with me? Everybody? Okay, we saying no. Okay, we'll get back to it. Don't even trip. It's not even that hard. You're not with me because you overcomplicate. You're thinking too much. Just rock with me. 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 I'll show you that. Don't worry about where it's at. Where the delta at, Trap? Don't worry about that. Just listen to me. Bro, don't wipe your head with the purple towel. Don't wipe your head with the purple towel. Check me out. Just listen to me. I see you, family. Just listen. Don't worry about, I'm going to walk you through all that tomorrow. Just listen to what I just told you. The problem be, we don't grasp it because we ready to ask the next question. Just listen to me. Right. Deep in the money, we talked about that. 15% to 20%, right? Already baked in. So we looked at this current stock price on the side. It said at the time, Apple was 146. So we bought a deep in the money contract. Means we buying a contract with equity already baked inside of it. Everybody understand that? Do I need to pull the Louis bag back out? I shouldn't have to. We went through the Louis bag already. I shouldn't have to. I shouldn't have to pull this back up. All right. Check it out. So if we see that this option at the time, Apple stock price was 146.97. So what we did was we said, yo, we wanted to go deep in the money. So we did too. We did deep in the money. We did out the money. Don't worry about the out the money right now. We went in the money. We went deep in the money. So what we did was we said we went deep in the money is 15 or 20% baked in, already in. What I mean by already in. Okay, I got to bring the Louis bag out again. The Louis bag was selling for $550. And Dev got it for $450. He bought it with $100 worth of equity already in it. Why do I feel like y'all only understand the Louis bag because it's design? I feel like y'all only understand the Louis bag because it's design. You feel? I feel like y'all only understand the Louis bag because it's designer. All right. So that's what we mean. So at that point, Dev, if the bag was going for $550 and he bought it for $450, then he bought the Louis bag deep in the money. He bought the Louis bag deep in the money. He said, Chap said, hey, Johnny, got 10 apples. Right? So he bought the Louis bag deep in the money. Right? So it doesn't tie to resistance level. Remember what I said, except for deep in the money. That's why I asked you to listen to me. That's why I said, listen to me. I said, this does not matter with resistance. You feel me? All right. So let's go back to that now. So at the time of this, the current price was 146. We said we wanted to go deep in the money. Why? Because with deep in the money options, you're already buying it with intrinsic value of equity already. You don't have to go get it. It's already there. So the market is going to charge you more the safer you play it. Just let that be a thing. The safer you play it, the more the market is going to charge you. The market wants you to take risks. They want you to put the game in their favor. Anytime you put the game in their favor, they're going to reward you more. For us, we're going to show you deep in the money and out the money. So check it out. The current strike price at the time of this play was 146. We had 5% is just in the money. 15 and 20% are deep in the money. Now, the 20% deep in the money is going to cost you more than the 15%. Why? Because you're playing it more safer. You're getting more equity. Everybody with me? Everybody understand what we did? Okay, so check it out. 146. Check this out. Simple right here. Check this out. 146.97 minus 15% equals 124.95. 92. Right? So we decided out of this one and this one, the 117 stock price probably cost us a little more. And now we're looking at bid and ask. We'll show y'all all that tomorrow. Just want y'all to see the examples. We'll go over bid and ask price tomorrow, right? That's why I don't want to shove all this at one time. And that's why you're going to have this replay for a whole day. Tomorrow, when you listen to this replay, it's going to sound easier. I promise you. All right. So we decided to go with the 124 call. This was deep in the money. That is a deep in the money call. All right. For the out the money, we went with a 169. Now, sometimes, let me say this, it may not be a 169. So now we'll go to maybe a 170. You know, we'll stay in our bracket. We'll talk about that tomorrow too. So the 170 call was what we did. And as of right now, if I am looking at my portfolio, let me just see what we're looking at on that one call that we did in October for Apple at 170. I am up 204%. We did that call in October. Before we get too further, let me say this right quick. Do I have any trap masters in here that are in that Apple call that we did from the last class? Can you just say yes in the comments so that people can see it? Okay, question. Shantae, can you unmute yourself right quick?
Hey, Trap.
Before that, last options class. How many times did you do options before?
Never.
Was that your first class?
Yes.
Did you do that play?
Yes,
But you actually shifted a little bit, right?
I did because the price dropped over the weekend. So
Mhm.
I evaluated the play and I got in for $5 less. So I got in for $165. And per the strategy you taught, I opted because I was new. I got for January, I paid for a little more time to make myself comfortable.
As of right now, what are you up on that contract? You know?
173%.
Good job. Thank you so much, Shantae. Jabari, I think you did a paper trade on it, and that's cool. Jabari, could you come in right quick?
Yo, I'm here.
All right, Jabari. I think you had played with options a little bit before that, right?
Barely.
Barely? Okay, cool. What was you up on your paper trade on that contract?
Let me see. Come on. 207%.
207%. Cool. And Jamila, my right hand, was in the class. First time doing options. Jamila, right quick, you did that play. I think you shifted it a little bit, right?
No, I just waited. You know me, I'm ultra
Yep.
patient.
Yep. You waited till it went down some more, and then
It went down to 5. I got it literally at 575. So I waited a couple days to 575. So I'm sitting right a little bit over 200%, about 220.
using the same strategy.
Same strike.
All right, cool.
Yep,
Good
same
job.
strike.
That's all I wanted to know. So what I'm showing you all is what we are going to go through over the next 2 days is going to do what I said is print you money. What is going to help you is staying patient. All right, cool. I'll move forward. All right, so here it is right here. Show it to you a little better so you can see it. The Apple Replay. And the reason why I'm letting you see this is because I want you to be able to see it and then you can move and go. Okay, so here it goes. We did the Apple Play right here at September 22 expiration, strike price $170. Price range from $8.25 to low $6. High, as of right now, the high was $25.50 for those same contracts, right? 309% to 425% growth on these options contracts. Why is that? Because we did something that most people don't do and something that people do not talk about, and that is getting options contracts at a discount price. All right, cool. Here we go again. Apple Replay exit, $6 entry approximately, multiple contracts, close partial, and let them run. Meaning you could have took some, let the rest run. It's okay. If you have one contract, you could have decided to hold the 100% or 11.8 on 11.8 at $12. So we did this contract in September. In 2 months, it was up 100%. In 2 months, it was up 100%. This is why I'm telling you, you only have to do 6, 8, 10, 12 trades a year. You don't need 40 trades. You don't need 30 trades. You don't need 25 trades. All you have to do, because the market, so I will say this as well, I am more of a buyer than a seller. I am more of a caller than a putter. The reason why, the market goes up more than it goes down. The market goes up more than it goes down. I'm going to be 100% with y'all. Y'all like, I rarely do puts. And when I do them, it's on something that I sort of ran up and I'm like, no, that got to come down. It done ran up 300, like on GameStop. I made $30,000 in one day. Why? I'm not going to lie. I got lucky. I said, yo, this thing ran up 500% in a week. It can't keep doing this. I put a put in. The next day it went down 20%. Right? So I don't even advocate doing puts because the market goes up more than it goes down. All right. Show y'all something. Rinse and repeat. This is why we do that. Check it out. A $6 contract. One contract equals $600. So check this out. 600 times 2 got $1,200. We rinse and repeat. We took that $1,200, got 2 more contracts, got $2,400. We rinsed and repeat. Took that $2,400, got 2 more contracts, made $4,800. Took the $4,800, took 2 contracts, $96. Took the $96, got 2 more contracts, did $19,000. Then $19,000 took 2 contracts, turned into $38,000. Yo, I didn't even, this is possible here. I'm not telling you nothing that's you can't do. I didn't tell you, yeah, we took $600 and turned that to $100,000. I didn't tell you that. The objective, the one thing that Leap Options will is going to cost you a little bit more than normal contracts. Why? Because we are buying them out 9 months to 18 months. I don't use 2 years or 3 years because I can get more done in 9 to 18 months. But as an investor, you can do that. For me, I'm in that 9 to 18 months. That's a great window for me. Jamila, can you mute that for me, please? Right? The reason, I'm gonna say it again, y'all. Most people lose because they buy options contracts too high. Trappers, we will wait for quad winching and other events to give us options contracts at low prices. Again, let me tell y'all, this is it. This is what I want y'all to see. Again, don't worry. Tomorrow we will go through more. We got more stuff to cook. I don't want to kill y'all all in one night. So check this out. The same contract that we got, I want you to see something. We got it here. This was in that $8 to $5 price range. So I think I got it right here. Jamila waited a little long and got it here. But think about this. That same contract was at $18. Now I want you to see something. I want you to think about something. Imagine you getting that contract at $18 and it dropping to $6. Wouldn't that hurt? Because you now had to wait. Check this out. If you was in a league or anything else, or if you was in a trade anyway, you never saw this guy back from January. This didn't come back till December. So you watch this thing bleed. You feel me? Where we just waited to quadruple winching and say, all right, cool. So check it. Let me say this too. Let me say this as well. If we are patient for these events, even if you went a little stronger, what if you got it here? Or what if you got it here? Or here? All of these highs, you still had to feel this. But let me show you something. This is what I like. Look at this. Quadruple winch, March. See it? It's the tail of the tape. Quadruple winching, March. Quadruple winching, June. You feel me? It doesn't fail. It doesn't fail. And now look. We at winching again. We at winching again. This the rules of the game. This the rules of the game. I'm not trying to act like I'm a genius, yo. I'm just saying, I like to make it simple. You feel me? I ain't a genius. I just figured out something. I'm like, yo, I'm a fundamental investor. Because I'm a fundamental investor, I just understand when the market switches up. Okay, cool. Why would I try to buy contracts too high when I can just wait till the market switch up and give me what I need? You feel me? All right, so let's go through this again, and what we'll do some Q&A. Did I cover this right? Okay, so today we did performance, we did support and resistance. Okay, so we'll cover this open interest, volume, bid and ask, and setting prices tomorrow. But check this out. I want to ask y'all a question. When we did the deep in the money, did we understand that? Did we understand that? See something? All right, Jamila, let's get some questions in.
All right, so everyone, please remember the rules. Just don't unmute yourself. We're gonna actually allow up to 5 questions for this part, but want to encourage everyone to go back, grab the pre-work to make sure you fully understand the basics of options before next class, as well as watch this video on repeat. It will start to make sense. It's like anything else. When you hear it for the first time, you're going to have a ton of questions, but let it sink in and be sure to take notes. So we're going to start. We got 5. We're going to take 5 questions, and we're still answering questions in the comments as well. We're going to start with Jason Green, and then we're going to Kyrus. So Jason Green, you're up first.
And I'm going to just be real with y'all. Like, if y'all wait on events, like some of my trap masters in town, they was like, yo, that PayPal event, we got that thing down all the way to 181. I'm like, that's a good event. Like, if we can get great, fundamentally sound companies and events, so the quad wins, and we know those are 4 events that are going to happen. If we just put 10 stocks in our arsenal and wait for that discount, like nobody talks about that discount right there. And tomorrow we'll show y'all some more, like how to look at those prices. It's a game. It's a different game. It's a different game. And yes, we will look at that from during that 7 to 10 day time period. E-Trade. So usually that 7 to 10 day time period is the time period that I figured out. But like, yo, that 7 to 10 days is where that thing dipped low at. You know what I'm saying? No, during winch. So if you know that winching is on the 3rd Friday, if you look in that 7 to 10 day time span, you can get those options at discounted prices. You will get the replays, y'all. Don't even trip. You will get the replay. Don't even trip. Don't even trip. Don't even trip. All right, let's go, Jamila. What you got?
You got Jason Green first. Unmute yourself.
Jason, what's up, family? Wednesday. I keep saying tomorrow. Wednesday. There you go. Jason, what's up, brother?
You got to unmute yourself. I'm not showing that you should be enabled. Oops, let me make sure. Try now, Jason.
All right, that's better. Thank you, Jamila. Thank you. Hey, what's going on, family? What's going on, everybody?
What's up, family?
What's good, man? I just wanted to make sure that I was understanding what you were saying, especially when you were going over the slide where you said rinse and repeat. So in the slide, if I'm understanding, say, okay, we got a contract at, say, $600, right? And we bought 2 contracts, that would be $1,200, right?
Yeah, but you ain't buying those $600 contracts, man.
No. No. We get it at a discount, which is going to say $6.
Yeah.
But because each contract has 100 shares, so that's 100 times 6.
Yeah.
Okay, so we bought times 6.
Yeah.
Okay, so we bought 2 contracts. So that would be 1,200.
Yes, yes.
So once we're up on those 2 contracts and we find our profit point where we're going to take profit, then we then use that profit and rinse it and invest it.
That's it. Rinse and repeat.
All right, got you, fam.
Rinse
Too
and
easy.
repeat, brother. It's easy. I think sometimes we don't think it's that easy, but it's really that easy.
Got you. I just wanted to make sure that, all right,
Yep.
that's what I'm thinking. That's how you were breaking it down.
Yep. Let me ask this question right quick. So some people saying we wait 10 days, we wait. So that's why I was glad I brought the trappers up. So remember what they said. Shantae said the price went a little lower. So she switched it. Like I got in at 139, 140. Shantae said it went a little lower. So she went in at another price using the same formula we're going to use. Jamila said it went a little lower for her. So she used another price. So she went a little lower. What I want us to understand is, like, if we understand where the discount is, you don't have to wait to the bottom. No, I'm not trying to time the market, y'all. You're not trying to time the market. All we doing is saying, okay, these are my 10 companies. Cool. This is where the option chain was at before. Quiet winching. Boom. It dropped down here. It dropped. Cool. Let me get in right here. If you feel like this is your go-to point, stick it and go. For me, my go-to point was I got the option at $6, right? Jamila, Shantae got it for $5, right? It's cool. Like, don't get stuck on where do I find the bottom at? You're not doing that. You saying this is what a contract. I'm not trying to wait from the bottom. I'm looking for a point where I feel good about it, right? If I know these things are selling for $10 and it's now in this 10-day period for me, and also an event could be going on. Like right now, what we know is, yes, always the 80 delta when you deep in the money. Remember the 80 deltas for deep in the money. But remember this too. Like, I want y'all to be conscious of what's going on in the market as well, y'all. Right? Be conscious of what's going on in the market as well. So even though we're in quadruple winching time right now, you still have an event that's taking place that has the market scared, which is COVID and interest rates. Like, we got to be stop trying to hold on to something verbatim. Like, don't do that. Like, we got to understand, like, yo, this is what's going on. This is like, and I think that's what happened last time. If I'm not mistaken, we had winching and then we had an event going on at the same time, huh, Jamila? I think we had the lawsuit going on with Apple at the same time. We had the lawsuit with Apple and Epic Games going at the same time, so that drove it down a little further. Right?
That is correct. Yep.
Let's be mindful of, it ain't in the 7 to 10 days. I don't know what y'all. No, there's another event. There's an event. So we got to be conscious. Yes, market days. We got to be conscious of what's going on in the market as well. So you have an additive. It's like you got the quadruple winching going on, and you got COVID, and you got interest rates. So now we're saying, okay, cool. The quadruple winching did this. Oh, bam, COVID and interest rates doing this. So now it may go down a little cheaper. It's okay. Like, I want y'all to be like, let's use this thing is smart. Let's use it. Yo, we got this. Next question, y'all. I like that question. Next question, Jamila.
All right, we got Jason. I'm sorry, we did Jason Kairos.
Hey, thank you. Yes. So, okay. So my question goes back to that first example that you had with the Louis bag. So I know in that example, he had bought 2 contracts, right? And then he sold one, I believe he sold one contract to pay for his right to buy the second one. Am I getting that mixed up?
Yeah.
All
right. So
I guess the question.
Go ahead.
So I guess the question was, like, if he didn't have $1,200 or whatever that number was, $112 to pay for the right to, not the right, but when he was exercising the contract, like you have the right to either sell it back to the market or you have the right to own the whole 100 shares. So if he didn't have the $112,000 to own the full 100 shares, would he
just sell it to the market and get his money?
Okay, unless in your example he had two contracts, then one would cover.
Mm-mm.
He would have to sell them both.
No, so if he had the money, then what he would do is, so you can't exercise and say, I'm gonna use this to buy that. You can't do that. So you gotta say, the only way you can do that is if you were to sell that, get that money, and then say, I got one option contract left. Okay, now I want to exercise that other option contract. Right? You can't say, you can't say, all right, I don't have the money. So how I'm gonna buy these? I want to own them, right? You may not want to own them at the time. So you don't have the money, you don't want to own it. You just take that prop. Okay, cool. I'm gonna sell them to the market, right? So if you say he has two contracts, so he sold one, right? He sold one, he took that money, right? So now he still have the other contract. Now if you want to buy that other one, you can buy it.
Okay, gotcha. And then this is like a soft follow-up to that one. When you're buying two contracts, are you buying them two at a time, or are you buying like one contract and then like, let's say another day you buy it for the same expiration period, same, it might be the bid and ask price might differ at that point, but are you buying them separately or are you buying them together?
So you can buy them separate, but they won't be the same. It will be individual contracts at that point.
Mm-hmm.
Right. So if you go in, you buy two contracts, those two contracts go together. If you come back tomorrow and buy the same expiration date, if it's available, then that's a different options contract. That's a different options. That's a different transaction. That's a different transaction.
Okay. Gotcha. Thank you.
Not a problem.
All right, next up we've got Zachary.
Jamila, why are we echoing?
I am not sure. Let me double check some things. We should be good. Zachary, you're up.
I know you're good. Yep, you're good.
Yo, what's up?
What's happening, family?
You good?
Hell yeah, man. How you feel?
Yeah, good. My question is, why do we go when we buy deep in the money? Why do we go like 15% and not around 10?
Okay, so 10% isn't deep in the money, it's in the money. So 15 and 20 is considered deep in the money. For me, again, you can go with in the money. I prefer deep in the money because there's more intrinsic value inside of that.
Okay.
But I don't want to exceed the 20 because now I'm paying too much for it.
Yeah.
You know what I'm saying? So 20 is my resistance. Like, nah, we ain't going past that.
All right. Thank you.
Great question. Next. Where we at, Jamila?
Next up, we've got Steph. Unmute yourself.
Good evening.
Good evening.
So of course, I want to understand what you were saying about E-Trade, because I know the instructions you had to set up TD Ameritrade, but you mentioned E-Trade related to quadruple witching, and so
E-Trade, yep.
Yeah, E-Trade. So what is it? What is it special that E-Trade that we can do? I don't understand this. We can only execute, or we can only buy contracts during that witching period using E-Trade. Is that what you're saying?
You can use anyone. It's just what I prefer to use.
Oh, okay. So we could do that in TD Ameritrade as well. Okay. And then with the, I think that's it. Thank you.
Mm-hmm. Yeah. That's E-Trade is just what I prefer to use. Why do you like E-Trade? Just what I like. Okay. Just what I like.
Okay.
Yeah.
Thank you.
Yep. Let's go, Jamila.
Next, we've got Akeen. Akeem Archibald.
Yo,
With you,
Yeah.
fam.
yo, what's happening? So I got a question. So when you're buying the option, say say an Apple option costs $600 for the premium. So when that option scales up, do you keep the premium, or does the premium come back to me plus the profit?
Hell no. See, now you being greedy, you hear me?
No, I'm just yeah, I just
No. So when you give, so let's say if I'm the seller,
Right,
once you give me the premium, that goes in my pocket.
right.
Right? You don't get that back. That's for me. That's what you gotta pay me to play the game.
Okay. So basically I give you that 600 and then everything else is my profit.
If
Get
if you
10
hit,
quick picks too.
you mute
10 just random picks.
mute that.
10 random. Which game? Fireball.
All right, I had to mute it, Jamila. Unmute him again.
Yeah.
All right. So, boy, trying to go crazy. That boy want 10 quick pick. That boy want fireball. Boy want scratch on. That boy want the lucky 7. Get that boy everything. That boy the options and the lotto at the same time. That boy will be rich quick. Nah, but look. Nah, my bad, King. It's a little joke, bro. So once you pay me for the premium, that goes to me. That's for the seller. That's why the seller has the obligation, right? And the buyer has the right. So now anything that you hit, so if your contract gets in the money,
right,
that's all you. But you don't get back what you spent unless you get it inside of that contract. You feel what I'm saying?
Unless you make the profit, basically.
Unless you make the profit back. You can't be like, all right, Trap, this isn't the money, give him my money back. Nah, you go about your business. Go back to the connect and holler at him. Yeah.
All right, for sure.
Yep. Good question, man. That's a great question. Which brings me to this. I'm glad you asked that. Which brings me to this point, right? So the reason why I like Q&A is because it helped me bring other stuff out of my brain. Which brings me to this, right? For me, I'm gonna just keep it 100 with y'all. I'm at a point in my career where I don't touch my options unless I am up 100%. Because at 100%, I've made back what I put in. Feel me?
Yeah.
Now, it's easy. So that's the thing. Like sometimes you'll see people like, I made $8,000 a day. Okay, cool. How much did it cost you? You feel me? I made such money a day. Cool. How much did it cost you though? Right? Like a lot of times people can play that game because you don't know it. You just like, I made $8,000 a day. Right? That's cool, but how much did it cost you? So for me, and I'm not touching nothing until mine say 100. After I see 100%, I know I done now got my money. I done got my re-up money all the way back. You know what I'm saying? I done got my money back. Everything I paid for that, I done got that back. And so now, this is the dope part. So let's say, that's why I use the 1100 because 550 is 1100. So now, if Dev was to sell one of the contracts back, he now took his re-up money plus some back, and now he's playing with just house money. You feel me? Yeah. He playing with just house money. You feel me? So for me, when I told y'all I'm up like on the Apple trade, when I told y'all, okay, and I showed it before when it said, yo, Trap, like, how many contracts you bought in the Apple trade? Well, I bought 75 of them. I'm up 204%. Bought 75 contracts. Feel me? So I done got my re-up money twice. You know what I'm saying? I bought 75 contracts. That'd be my thing. Like, multiple ones. Like, I'm up 100. I don't touch mine until I hit 100%. Because at that point, I've made my whole re-up money back. Yeah, you can be in a green. Like, I got some of them right now. I'm in a green, what? You know, I'm in the green on, I'm in the green 75%. I'm in the green 80%. I'm in the green, let me see, 124%, 203%, 12%. I can't touch that. 12%, 104%, 292%, 205%, 216%. I can touch them, but I'm also down 37%. I'm down 15%. I'm down 46%. You feel me? So anything that's up more than 100%, now I can be like, all right, cool. Let's play the game. I can get my money back. I can rinse and repeat. It's all good. You know what I'm saying? Make sense?
Yeah, it makes a lot of sense.
I'm not going to tell you to do that because you may say, you know what, let me peel back some profit right now. You know, it feels good sometimes to see a little green, put a little money.
So question. So like, okay, say you do buy for 600, it goes up 100%, you get your 600. Then you can pull that you can pull that 600 out and just let it run for profit, basically.
You sell that contract,
yeah.
You get your re-up money back. Now you just let the house run.
So yeah,
you don't care.
Would you recommend that? Like that's what something.
Yeah, for sure. So why I recommend that? Because now the object of the game is to play with the house money. You know why most people lose in the casino? Because they don't know how to walk away. They don't know how to play with the house money. People lose in the casino. Most people go to the casino and win. They lose because once they get their money back, they won't keep playing. Once they lose the house money, they won't lose the house money and the re-up money. The longer you stay in the casino, you're gonna lose. Well, people lose that. If you can learn, this is real talk, everybody in here. If you can learn to be patient, to let that thing run and get your money back and just play with house money, the game gonna change forever for you. The game, if you patient enough to do that, the game will change forever for you, family. Good question. Jamila, let's go.
All right, our last question for the night is Andy.
Andy, what's up? Let's take two more, Jamila, after this. I feel like we got a lot.
Hey, what's up, Trap? What's going on? Greetings from Brooklyn.
What's happening, family?
Greetings from Brooklyn. What's going on? All right, so I got two questions for you. All right, wait, when you talked about in the money, and deep in the money, when we get that discounted price, right? I wanted to understand, is that discounted price listed, or we have to wait till we get into that quadruple thing you talking about with March?
So okay. Good question. So remember when I took you to the chart?
Yeah.
So now when you look at the chart, so this is what I do all the time, yo. If the market green, I don't got a problem with, I don't got to look at it. I already know what's going on. When the market turns red, the first thing I'm going to do is, okay, how red is it? Is it 2% red? Is we at 3%, 5%? Usually a 1% probably not going to do you nothing. You talking 3 to 5%? Okay, now let me go look at my 10. So I want you to write this. Good. Great question. You made me, so that's why I say you do two more. A question make me open my brain up. I want you to write this on a piece of paper. In your journal.
Yes, sir.
In your journal, I want you to put down your 10 companies. And then I want you to write down the current stock price of that company before you look at it. And then I want you to write down the strike price after you've done your research. So I want you to write down a company, and then I want you to write down the current price on the market, right? The current price on the market, whenever you're looking at it. And then next to that, I want you to do your homework. I'm gonna show y'all tomorrow. This is the stock price. These are my strike prices, right? In the money, out the money. Deep in the money, out the money. Deep in the money for all your things, right? I want you to write that down. And then I want you to write the bid, whatever that ask price is for it. So now when you go, whatever the current, whatever the current contract is selling for, which what I'm gonna show y'all tomorrow. that $15, $18, $22, whatever that is. You write those down. I mean, Wednesday. My bad, y'all.
It's all good. You working hard. It's all good. Don't worry about it. Go ahead, man. Yeah.
I want you to write down your 10 prices. Yes, you can use ETFs. We'll talk about that tomorrow. The ticker symbols, it should be in a row just like this. Your ticker symbols, your 10 or 12 ticker symbols, the current stock price. And then I want you to do the strike price after you've done your research. So after you've done the research, this is my strike price. In the money, deep in the money, this is my strike price. Out the money. This is my strike price. Deep in the money, this is my strike price. Out the money. Do that. And then I want you to write down, go inside. I'm gonna show y'all what we did with E-Trade. You'll go inside and I'll show you how to find it. I thought I just showed you, I'll show you again. And tell yourself, this is what the option is selling for. The $18, the $8, the $6. Write that on the side of it. So now what happened is, when the market goes red, boom, you go straight to your chart, you go look at your companies, and you see what's on sale. Okay, this was the strike price I'm looking at. This how much that contract was selling for. This is the 174 strike price. It was selling for $10 now. It's selling for $6 now. Circle that. This is the strike price, 192. It was going for $18. It's going for $14 right now. Circle that. Now you know exactly what you don't got. I don't want you scrambling.
Sir.
I want you going there. Boom. 1, 2, 3. It's easy for me. Once the game, I'm gonna be honest with y'all. I just be chilling. I'm chilling. You know why I'm chilling? Because I'm waiting for this thing to go on a discount for me so I can do a couple things. First, I'm looking at my long buying holds. Is anything on sale for that? Okay, cool. Good. Second, options contracts. When I go to options contracts, I'm like, okay, cool. Here's my prices. Here's what they were selling for. Is any of these, it don't even take me 20, 30 minutes to go look for that. These are my prices. This was the 174 strike price. How much was it? It was $18. How much it is now? 16? Cool.
Gotcha.
You go through that and you find in your 10 companies, you find the one that make the most sense that you can get let me go get my full contract.
Sir, yes, sir. Thank you, brother. Thank you.
More contract. For sure. Yes. Let's go, y'all. Yeah, I'm gonna give you an example Wednesday. Yo, I got you.
All right. And then this is the last question. I think someone asked, but I just want a little bit more clarification, right? Yeah. So you made the reference to the Louis bag, right? Mm-hmm. So let's just say the Louis bag was going for 500, but then the strike price was 550, right?
Mm-hmm.
Okay. So let's just say it goes up to 550. Could we sell at 550 or no? We can't profit at that.
You could sell it for 550, but did you make anything?
Oh, okay. So we won't get no money back if we sell at 550.
I mean, you can, but
it's not much.
What did you get?
Gotcha.
Now let me tell you this. The only way what happens is it drops so if it drops below 550, then all you can lose is what you put up.
Yes, sir. Okay.
All you can lose is so let me say this too. If it goes below 550, you do not lose until you sell.
Gotcha. Okay.
So if you don't lose nothing until you sell it. You feel me? You don't lose nothing until you sell it. Once you sell it, you lost it. You locked it in.
Yeah.
If it goes down, remember, we doing 9 months. Doing 9 months alone.
Yeah.
So if it goes down, you sit back.
Gotcha. Okay.
You sit back. But in the beginning, I want you to give yourself that, I gotta be, as an educator, I gotta tell you the correct way.
Yes, sir.
Is find your losses that you can cut early. right? So if you could cut it at 10%, if you could cut it at, but if you were, you know, you're like, man, I ain't tripping. Let that thing do what it do.
Gotcha.
You
All
know
right.
what I'm saying?
Gotcha. Thank you, brother. I appreciate it. Thank you so much.
Sure. Jamila, let's get 2 more and then we go.
All right, next up, we've got Trey.
Trey, what up?
Peace and blessings, King from Baltimore.
What's good, family? I got people out there, you hear me?
Hey, let me know when you come back. Love to meet you.
You got the queen with you? I see it. I like that.
Yeah, my queen actually is the one with the question, so I want to give her the floor. I'm going to save the answer for the Q&A tomorrow.
Hell yeah. What's
Hi.
good, queen? How you
Hi.
feeling?
I'm good. Thanks for asking. So all of this is really, really new to me. Like all the language is new to me, and I might be jumping ahead, but I want to make money and I want to make money alongside my husband. So that's why I'm here. So you talked about the strategy of the quadruple witching.
Yep.
And I might be jumping ahead, but it made me think that if you are waiting for those special dates in the 4 months or whatever, would you pull out before
the next one?
Before the next one, if like, do you understand what I'm saying?
Mm-hmm.
So,
So
or am I jumping ahead?
No. You good. So you saying like the one
When do you get out before it drops again?
Yeah, so you saying like the one in December, will I get out of it before March?
Yes, if it's up to your year.
Good question. So this is why we doing, 9 month, 1 year, 15 months, 18 months. This is why I do them like that. Here's the dope part about that. That's a great question. So let me put this out there, right? Because I'm gonna say this in 2 ways. I'm gonna say this 2 ways to answer that and to add this, right? I typically only get out of my trades, and I want you to get out of them 45 days before the expiration date. Anytime after that, you plan with fire, because now the time speeds up, right? The closer to the expiration date, the more the time speeds up, right? That's one thing. Everybody got that? 45 to 60 days, cool, time decay. Anything under the 45 days, if anything go wrong, you don't have enough time to shake back, right? All right, so that's on the front of my brain since you asked that question. To answer your question, here's what I love about this, right? So let's think about this. So we got into the Apple trade for last quadruple winching, right? We're up now on average. The average person right now is up about 160%, except for the people who did the deep in the money, they up about 50%. Remember, because they bought it with intrinsic value already in it, they not as far up as we are, but they prices are baked in, right? So we'll get out of the money faster than them because they bought it with intrinsic value. So let me say this. As of right now, me being 200% up, I'm not even worrying about this quadruple winching. The market, to take them 200% for me, the market will have to tumble down a rabbit hole. You feel me? That's the dope part about us getting it at a discount, right? The dope part about us getting it at the discount prices is because by the time the market does correct itself, we so far up, right? We so far up, we don't mind giving it a little back. It's cool. Like I was up probably 270% on that trade. But the dope part about it is it done took me down to maybe 220. That's cool. Within the next 10 days, would it be getting me down to 175? I'm not mad at that, right? Because once the market does correct itself, now I go back to running. You feel what I'm saying? Now, here's another dope part about it, Queen. Let's double down on that. This is why it's important, and I said this. Once we get the 100%, right? Once we get the 100%, let's take that money back and play with the house money. Now we ain't tripping at all. Why we ain't tripping? Because we took our initial investment back. Here's the dope part about that. Like now we're gonna talk about scaling our portfolio. Let's say you take that 100 back and that thing run up another 100. You know what you do right here? Let me take 50% of that. You see, it's easy to go up 200% if we buy it this way and if we invest in fundamentally strong companies, right? Here's the thing. You heard it. It wasn't for me. One of my trappers said they up 200%. One of them said they up 170%. And then Jabari said he's up 200% in the paper trade, right? So this is good. This is good profits right here, right? So let's say if everybody took, once it got to 100%, they say, you know what? Let me take my profit out. Here's the thing. I want everybody to do that. I want everybody in here to do that. You know why? Because this is what y'all gonna do. Man, it look good being up 300%. That thing look good. Now you don't want to touch it.
Mm-hmm.
That thing look good up 250%. Now you don't want to touch it.
You shot.
It's like looking at it. You feel me? You like looking at it. It look good. You feel me? Nah, we playing this thing to win, right? So I want everybody to make this a habit is like you hit your 100%. If you gonna do that, that way you get your whole investment back. Man, you take your 100%. That's your initial investment. You got all your re-up money back. You take that, let that thing run, and then you start scaling back, right? Of course, you need a lot of contracts to scale back, but that's the ultimate goal. Now the market can't beat you. The market can't beat you if you beat. That's why I say like this way, man, you can rinse and repeat this system over and over and over and over and over and over. It don't stop. It won't stop. So yes, Queen, if you that's the prototypical idea that I want everybody to use, that I'd say everybody to use, like use that method. Like, you know, you can scale back early, but initially you don't get your money back until you make 100%. That's all your re-up. That's everything you put in there. Get that back. Now let it run. You got your money back. I ain't really tripping on it, right? You got your money back.
Right. You can flip your profits, right? 2 to 4, 48. Yeah. Hey, Trap, I realized I did have one question, not know so much about the class, but over the holiday season while you were selling, I purchased this course and your Trapping Fundamentals course.
Oh, you good.
Yeah. So because I had a moment when I had something happen last month on my job, be like, you know what? I'm done. I'm gonna be like, this man, I'm gonna buy back my 24 hours, then hers, and then the legacy. But my question is, right, like hopping into this, since I have both and we're gonna be studying both, right? Where should we start with the fundamentals courses and like really dive into that first before we even do our first option play, or should we do both concurrently? How would you feel like would be the best strategy if we getting all this knowledge and we want to apply it ASAP?
2 brains better than 1. You feel me? You got 2 brains better than 1. You know what I'm saying? But I will say, like, now that you have the information from here, this is fresh on the brain. You know what I'm saying? But I will also be like going through that Wall Street Trapping course because now you truly understand what a fundamentally sound company looks like.
Okay. And
you know how to break that down. And once you see what that look like, now you know, like, here's my 10 companies that I really want to like deal with. And like, you can literally take those 10 companies and just like, okay, cool.
From a buy and hold perspective and from the options perspective too, right?
With that, because that's what I do. So when I take profits or something, the first thing I do when I take profit on one of my positions, I add it to my long-term position.
Oh, okay.
Yo, this is a machine. Like the machine print money. Like, I'm gonna keep it 100 with y'all. I have never spent money from my options portfolio. Why? This is a machine that print money. My money goes 3 ways from here. 1, to my long-term portfolio. 2, to my dividend portfolio. 3, to buy me more options contract. The goal for you is here's the goal. If you can get from 1 contract to 10 contracts, like once you start hitting 10, it's a game changer for you. Right? Like you want to just scale it. And I'm gonna give y'all some, like, my ultimate goal is to do one trade that makes me $1 million. That's my goal. So for me, I just keep adding liquidity to my account so I can do one trade that makes me $1 million. And I can say that to you because I don't want you to think that $1 million is not possible for you. It's possible for you because within the next 2 days, I'm gonna show you a blueprint. The goal for you now is say, how do I just keep scaling the blueprint? How do I go from 1 contract to 2, from 2 to 4, from 4 to 8, from 8 to 16, from 16 to 32? How do I get there? That's it. Like, it's not impossible because we know the machine print money. I'm not even telling you do nothing crazy. I'm not telling you do nothing superficial. I'm telling you in 2018, I made a post and I showed my trappers where I made 100. I was excited about making $200. I showed my trappers. I said, look, this is 2018. I made $200. I was excited about it. I went 2 days. I said, oh, I made $200 this day. I made $200. I was excited about it. This 2021, I'm telling you about 75 contracts. In 2018, I was doing 2 contracts. I'm telling you, I ain't doing nothing you can't do.
Thank you.
Not a problem.
Appreciate you, King.
Hell yeah. All right, Jamil, let's get one more up in here. You hear me? And then y'all, I want y'all to study this. And then Wednesday, we're going to get into some more stuff. So look at that. We talked about the deep in the money. I'm telling you, that's going to help a lot of people. That deep in the money breakdown at 10, 15%, that deep in the money going to help a lot of people. Look at that. Pay attention to that. Next class, we're going to talk out the money. We're going to talk ETFs. We're going to walk you through E-Trade, bid, ask, limit. Don't even trip on it. We got y'all. It didn't make sense. I'm telling y'all, a 2-hour class turned to a 4-hour class last time. That's why I refused to do that tonight. Let's get one more, Queen, before we go for tonight.
Next up, we got Kamiko.
Hi.
I feel like you've been wanting to ask a question, I swear, because I saw you.
You know, here's the thing. I'm in Trappers Anonymous. I have the course. But I feel like I don't understand. I feel like you're explaining things. You're talking about 100% like growth and all that, and I still do not understand. Okay. So the part that I'm a little bit lost on is that in that slide that you had where you explained that the current price for Apple was 146. And then when your strike price was 170, was it not?
Let's see. Right here?
No, later. So, well, I mean, even in that, your strike price is at 170. If today it's 171, then I don't understand how you're up anything.
No. So this was from October.
Right.
Okay, so this was from October. We bought it when we bought it, it was 139.
Okay.
139.
So you paid, to be clear, you paid 139 times 6.
No. I paid $8. I paid $6 and maybe 20. I mean, I guess I'll give you straight to you. I paid $6.
Okay. So you paid $6 times the 139.
No, where you get 139 from?
Because I thought that's how much it cost. That's how much the stock price cost.
139 was the current price of Apple when we purchased it. Right?
Right.
All right. If we paid $6, so all right, let's think. All right, that's good. Let's walk you through this. You with me? Me and you.
Yes, sir.
You. All right. The price was 139. It was originally 146. All the way down to 139 was when I bought in and some of the other trappers bought in. You with me on that?
You froze a little bit, but okay. When it was at 146, went down to 139. Okay.
Queen, you with me? I'm froze. Are you?
You're frozen to me. Is anybody else? Is he frozen to anybody else?
All right, let's write it
I
out.
think where
Now,
she getting it wrong is the option price is different from the the stock price.
yeah,
That's where she
yeah.
getting it
I
mixed up.
see it. That's why I want to walk her through it. You're absolutely right. So the 139 was the Apple price when we said, okay, this is it. The price of the contract was $6. You with me on that? All right.
Trap, you freezing, bro.
And I don't know what's y'all overloading my computer right now, yeah? Y'all got me burning my thing up, yeah?
Of course, like when you're explaining it to me so that I can understand it.
I know, right? You feel like this is personal, right?
Right.
All right, can you hear me? You with me right here?
Yes, sir.
All right, cool. Boom. $6 times 100.
Right.
All right. But I bought 75 shares. All right.
Yeah.
So actually saw this question. 75 times 100 means what? I mean, I had 7,500 shares under control. Right?
Okay.
All right. So now, don't look like that.
So the quick question. So it's $6 for the contract times the 100. So
No. $600 for the contract.
Got it. $600.
100.
Okay. Is that the premium or is that not?
Trap, explain to her where the $6 come from.
All right. So you're right. Tell me what you're missing.
Let me give it to you real quick.
All right, hold on. Let me do this right quick.
Start it from the beginning.
Yeah, that's what I'm about to do. So check this out. Somebody said she don't know what she's missing. Hold on. I got you. So the infamous Louis bag has came back into play. All right. Louis bag is back. You with me? Okay. If you need a visual, it's okay. So this Louis bag is $500. You with me on that?
Yes, sir.
All right. But for you, I'm selling these Louis bags 100. You gotta buy 100 of them at a time.
Right.
You with me?
Yes, it's a lot of 100.
All we gonna focus on is 100 right now. 100 of them. Here we go. So you say Trap. Okay. I think that this Louis bag will sell for $550 in a year. I said, put your money where your mouth is. You said, okay, cool. What you talking about? I said, okay. Well, for $6 per bag, I will give you the right to sell or take ownership of this Louis bag.
Right.
A year. Are you with me?
Yes.
Okay. Now, 100 of these Louis bags at $6 cost how much?
$600.
Boom. Let's stop right there. That is one contract.
Right.
You with me?
Yes.
That don't got nothing to do with the price.
Right. That's the premium.
That's the premium for one. But for me, I had 75 of them.
Okay. So 75 times 600.
So check it out. That's it. Next question. What's your next question?
So then
there we go.
we're because the bag is worth 500, right? And then your strike price was 550, right?
I'm with it. Don't overthink it.
No, I know, but here's the thing: when you bought it when the premium was 600, right? And that's when I bought it from you.
No,
and then
stop me right there. You didn't buy it from me.
Had the right to.
There you go.
Right. When it now goes up to $25 in December, right? That same contract is worth $25 in December, and say I decided I wanted to sell it. I don't understand where you make. It's like I kind of don't I'm confused as to where you make money, because I'm selling a contract. Because if I decide I don't want to, if I don't want to exercise it, right? I'm saying I don't want the Louis bag, like bump the Louis bag, and I want to sell my contract, and I want to sell my contract at a profit. How am I? If I bought it at 6 and I sell it at 25, then that's what I've made in the difference between 600 and 2,500.
Yes.
Okay.
Are you sure?
I guess.
I don't need you to guess. I need you to know.
Yes.
Okay.
And so that's what we're betting on by the expiration date, that it's going to go somewhere above $6 by the.
So here's what you're doing, right? So you kind of mixing some stuff up, but overall, that's it. So here's what happens. So now you took the price out. When you said 6 to 25, now you're talking about the contract going from $6 to $25.
Right.
Right. So that in essence, now you would say, instead of the Louis bags, instead of me wholesaling you the Louis bags for the right at $6, it's now increased to $25. Right? That's cool. You with me there?
Right.
You with me there?
Yes.
That right is actually what you're selling. You feel me?
Right.
So now we look at from a bigger point of view, what happens now is that the bags went from
Hey.
the bags went from 550 to, we said the bags went from 550 to 1,100, right? Right? So if you don't want the bags, you now sell it back to the market, right? You with me on that? All of that is now profit. You sure?
I think so. I believe so.
Explain
and so
it.
explain it to you. So from what I understand, you have two choices. Like if you are a buyer, you have two choices. You can exercise your right, or you can resell the contract before its expiration date, 45 days. And so whatever it is that you bought, the profit is whatever the difference between what you bought it at and what you sold it at, and before the expiration date.
You got it. You close. So now what you need to do is just look at the replay.
Got it.
Just take it. Because you're going to beat yourself up. Right? And I don't want you to do that because it's fresh. It's fresh. So you got it. Run through it and then look at this part again at the end.
Yes.
Right?
Thank you.
Good job. Good job.
I have one quick question for the queen. Did you take a look at the pre-work?
I did. I read the three.
So now that you've done it, you didn't quite understand it, you've come to class, go back and look at it again, and then go back and watch the replay.
Good job.
Got it.
It's gonna take. You don't allow yourself to be frustrated in the fact that you're not getting it. this is something completely brand new. And this is for everybody. This is completely brand new for a lot of people. I saw when he asked the question, there was at least 400 people that put this was their first time being exposed to options.
Mhm.
You are not going to get this by listening for just 2 seconds. It doesn't work nothing works like that. It's going to take a little bit of repetition.
Which is also why I want y'all to have it for the whole. Y'all gonna look at the replay a few times. Y'all have it, go over it, don't trip. Then once we add Wednesday's class in, you see I said Wednesday, not tomorrow. Once we add Wednesday's class in, you'll have both of them baked in, and you can just start cooking, yo. And then don't forget that following week we'll have 2 days of Q&A. So now you bake that in with the Q&A. We definitely gonna get it. So don't trip if we didn't get your question tonight. We got another class, we'll get more questions in, and then we got 2 classes that's just questions. So we got y'all. Don't be like, man, try to answer my question. Don't trip. We got 2 days of just questions that we gonna do. So don't even trip, yo. So y'all gonna be good, man. Right quick, if y'all don't mind me asking y'all, how y'all feel about tonight's class? Just give me